welcome to AJ Bell Connect. My name is Billy Singh. I'm the BDM for AJ Bell Invest Centre, and I'll be your host for this morning's webinar. Whilst it's great to see people face to face and have a coffee, we understand that plenty of you couldn't make a face to face session, hence we're putting today's content together. So thank you for joining us. Today's session will be around 2 hours, and we'll make some time for you to grab a coffee part way through. For those of you who watch the session in its entirety, CPD certificates and a copy of your slides will be sent via the email in coming days. Please feel free to ask questions throughout the session via the chat function, and we'll endeavour to get back to you quickly. Failing that, a feedback form will appear on the screen immediately after the session. So please write down any questions for our speakers using the online form. We'll ensure all speakers receive your questions following the event. So if you're settled in the morning, ready to listen in, all remains for me to do is to kickstart our webinar with a short business update for AJ Bell Invest Centre. So just to kind of put you in the picture of our strong growth trajectory, here's our recent results just launched. So well over 440,000 new customers, well, retail customers on the platform, so double-digit growth in that area, as well as in terms of the revenue. In terms of assets under administration, so we've had a 5% drop, but that's due to obviously market conditions and the volatility we've all experienced across the board. One of the key things I like to highlight on this slide is that we're a profitable enterprise, and that's becoming more and more rarer in this space, with the likes of private equity causing havoc within the industry and causing an array of problems for advisors. It's always a positive thing to see us well within profit, and that enables us to kind of reinvest back into the platform, upgrades, and also to kind of facilitate that low cost environment that you can kind of utilize and pass on to your clients. So moving on from there, what's on offer? Obviously, many of you are aware of our proposition, but just to kind of reiterate, this is the range of wrappers. So it's an open architecture platform with a range of wrappers alongside a junior suite of products, junior ISA, junior SIP, and a lifetime ISA, which is not always available across the platform space. And in terms of investment solutions, firstly, obviously, we have a funds and share service, which again is a full service offering over 4,000 different investment options, the unit trust, OINCs, ETF shares, and a range of functionality to kind of build your models with. And moving on from there, we have our investment partner range, so over 17 different major DFMs available through that service. And also we have our off-panel range there. So this is where you can kind of hold things like trustee investment plans, the likes of Pru, external stockbrokers, and what's of a renewed interest, so deposit accounts through the kind of bank account section with a higher interest rate offering out there in the marketplace. And then we have our NPS solutions. So this is obviously a way you're outsourcing your investment management. So the three latest additions, Betafolio, EQ Investors, and Saracen, again to help diversify your solutions. One thing to note in this area is it's not always easy to cross-compare these solutions unless you have a subscription service through FE Analytics. So it is a welcome news when Morningstar launched their portfolio database that can compare well over 800 different portfolios in a simple database format, with just a few filtering options to kind of see solutions side by side. I'm more than happy to kind of send this link out if you've not come across this in our follow-ups. Then moving on to our kind of own investment solutions. So this is just a few headlines to kind of put you in the picture if you've not come across these. So we have 6 outcome-orientated multi-asset solutions, funds, and 6 core MPS solutions available in various investment styles of active, passive, pactive, and responsible. And the key thing about these is that they displayed significant resilience over the last 12-18 months in terms of drawn down less than half of their peer group and their benchmark. And this is through a robust strategic asset allocation process that's delivered a smoother return profile for your clients, not only protecting on the downside, but also capturing a good proportion of the up. And thirdly, they've come up to their 50-year anniversary, and we've had significant advisor adoption with well over 3 billion managed in these solutions, and they're going from strength to strength. And finally, I always focused on value, so they're priced at 31 basis points for the fund range across the risk profiles, and the MPS solutions start at 28 basis points. So if you've not come across this range, hopefully now it's on your radar, and I'll be looking to kind of set up individual firm meetings to kind of delve a bit deeper and help you with your due diligence around this kind of range. So moving forward, just in terms of performance on this range, on the left there you can kind of see multi-assets, and I've kind of cross-compared the balanced fund portfolio against some of the other peer group, as well as the benchmarks, so the likes of Vanguard, Threadneedle and Fidelity. And what's to note there is how we've kind of managed that downside over the last 3-6 months and over the year compared to our peer group. So definitely showing those resilient defensive qualities within those funds. And then if we move over to the right hand side of the slide, this is just comparing some of the managed portfolio solutions. So here I've highlighted the passive range of the MPS on the low risk scale, so the 20 to 40% equity, and then on the other end of the scale, so 80% equity. And again, it's just showing there how we've stacked up against some of the major well-used MPS solutions, and comparing not only against in terms of the ongoing OCF, but also the 1, 3, and 5 year figures. So definitely showing some outperformance there, and I'm more than happy to kind of delve deeper on a one-on-one basis around these. So finally, just kind of moving on to the support function. Again, this is imperative for a power planning team. So I head up the Midlands region in terms of providing support and helping you guys get the best out of the business development team and the platform and the investment solutions, alongside my two colleagues, Sam Joseph and Sam Hill. And again, we endeavour to kind of really spend time with you to make sure that you're fully up to speed and we can facilitate all the trading that is required. Moving on from ourselves, we also have our outstanding advisor support team, and this is obviously a really crucial team. And this team obviously handles a good volume of calls on a monthly basis, probably between 10 and 20,000 calls, and to have a response rate of answering calls within 20 seconds on over 93% of those calls is quite significant. So yeah, definitely a proud statistic to be we're proud of, and again, something that will be really beneficial to drive efficiencies within your own admin teams. So just in terms of up and coming developments, just a few things that we've got on our radar for the next kind of 12 months. One of the key things here is our overhaul of our client onboarding journey. So this is kind of looking to be launched around just after tax year end next year. And again, it's going to really drive efficiency, because we've had a lot of feedback from advisors over the years about how that part of our offering is a bit clunky. So we've definitely sort of fed that back, and we've got a result here in terms of a whole new proprietary module that's going to streamline that process, and it's going to be fund specific, and it's going to alleviate that need to kind of for yourself to kind of work out that blended OCF, where the system will do all that for you. Single point of data entry, multiple users that can save down different parts of the application or illustration and pick up at different points. So we're really happy to kind of demo that in the new year about what that's going to look like. And just wanted to, the other thing, so again, one-off investment into models, tiered advisor charging, secure messaging dashboard, a number of things there to kind of really improve the service that we're delivering on the platform side of things. And then finally, just to wrap up, what does this comprehensive service look like and cost? So again, always driving that low, additional value and low cost. So in terms of the fund share service, the charges for the SIPP, ISA and GIA are 0.2 up to the first million, and then they're tiered lower according to the investment level, and then they cap out around 2 million. And then based on kind of product segmentation rules that were in focus over the last couple of years, we launched our RIA, our retirement investment account, and this is targeted at that 200 grand and below client, where we're charging an all-inclusive pricing option of around 0.25, and there's no other ancillary fees included. So yeah, targeting that lower segment of clients. And then finally, just in terms of investment solutions, 31 basis points for the fund range across the different risk profiles. And then again, the MPS solution starting at 28 basis points. And then they obviously tier higher according to the active element. So that's it from myself. Thanks for your time. If you have any questions following that session, or would like a call from myself or the team to go into further detail, please use the chat function provided and we'll get back to you. Up next is Terry McGivern, Senior Research Analyst for AJ Bell Investments. With this session, you can't be passive without investing passively. He'll look at how passive investing has grown enormously over the last decade, and as the active managers have struggled to beat benchmarks, fees on passive funds have continued to fall lower. Passive investing, you may think, is a simple buy and forget approach, but there are a number of factors that investors need to get right to ensure that the passive investment strategy is working as hard as it possibly can. And Terry is here to discuss those with you today.
Hi, and thank you for joining this webinar today. My name is Terry McGivern. I'm the Senior Research Analyst on AJ Bell Investments, and I'm responsible for passive research. So I just wanted to talk to you today about passive investing. As the title of the slide deck is, you can't be passive about passive investing. And it is something that I think is an important concept. Obviously, passive investing has grown enormously over the last few years, which we'll get to shortly. But I think it's important, and we think at AJ Bell it's important that advisors and investors have a good grasp on some of the factors that impact when you're researching passive investment funds. And that's what we're going to talk about today. So the first place to start is looking at a textbook definition of what passive investing is. And it's an investment strategy which seeks to follow a rules-based approach with the aim of tracking a reference benchmark index. And the aim is to track the benchmark index rather than outperform it, which is what you would expect in an active fund strategy. And passive investing has grown from early, probably around the 1970s, 1980s, when it first started to gain traction in investment markets. It's grown enormously. Globally. Now we look at passive investing, and across both ETFs and index funds, which are the main two vehicles where passive investing is done, we're now approaching assets of around $20 trillion, or in index strategies, which, as you can see, since 2007 in this slide is a huge growth story for passive investing. So it really is becoming a pretty dominant theme in investment markets, and that's not just a global story. When we look at the UK, this chart from the IA shows that since 2011, whereas passive or index strategies did represent around 22% of the total assets under management, this has now grown to around 32% of all assets at the end of 2021. So it is becoming a much larger part of people's investment strategies, seeing it much more prevalent in people's portfolios as people start to appreciate what passive investing is and the difficulties associated with active investing and actually beating the benchmark. But what is passive investing? And once we get under the hood, what things do you need to think about? What are you trying to achieve when you follow a passive investing strategy? So, as I mentioned before, passive investing it's a rules-based investing strategy, and an investor will select a benchmark index that they want to replicate the return of. For instance, something like the FTSE 100. The problem is that for that investor, an index can't be owned. You can own either the underlying constituents in the index to try and get the same return, or you can own a fund that does that for you, but you can't actually own the index itself. The index is just a calculation rule set that you're trying to match the performance of. So the aim then is to find the most efficient rules-based investment strategy, in most cases an investment fund, a tracker fund, which will try to match the chosen benchmark index return. And the most efficient product that you choose will be the one that minimizes tracking difference to your chosen benchmark. So as you can see on that graphic at the bottom, you've got your required benchmark index return, and you're trying to minimize either the underperformance against it and also the outperformance against it, because for a passive strategy to be working well, you're not seeking to beat the benchmark. And if you are beating the benchmark, you're probably doing something that is not present within the actual benchmark index itself. So minimizing the tracking difference, both positive and negative, is what you're seeking to achieve with passive investing. The thing when you look at passive investment funds, though, is them funds are designed to track their own reference benchmark indexes. So that's irrespective of the investor's preference. So whatever benchmark index that the investor has chosen to be their benchmark, the fund will have its own. Now, in best case scenario, that matches the investors, and then you're basically both trying to achieve the same thing. The fund is trying to match the same return as the investor's benchmark. But in many cases, that isn't the case. And you do see that funds will have slightly different benchmarks versus the investor's own preference. In that case, a fund that tracks its own benchmark well might not necessarily be a good fit if the index that it tracks is dramatically different to the benchmark that the investor has chosen. So any robust selection process has to identify products that are both good products themselves, i.e. they track their own benchmarks well, but they're also good fits for your investment portfolio, and they track your required benchmark well, which means that the graphic on the bottom of the slide shows an extra step versus the previous one, whereby there's a required benchmark index return. You're trying to minimize the over or over performance against the passive fund's benchmark index return, and then the fund itself is then trying to minimize the tracking error to its own benchmark. So there are a couple of steps and a couple of things to think about first that you just need to get correct in your mind when you're building a passive investment research process to understand how the fund's benchmark interacts with your own benchmark preference. One of the other things that you need to think about with passive investing is the wrapper that you use to achieve your investment strategy. Now, traditionally in the UK, mutual funds or index funds have been the way that investors have tracked and invested in a passive fashion. Very familiar amongst advisors and amongst investors in the UK. They have a NAV that's published once per day. There's a single source of liquidity in many cases, whereby it's the manager who creates and redeems the actual units in the fund, and that's done once per day. So there's obviously a lag between when you place your order by a dealing cutoff, and then by the time that the fund is priced and any additional units are created or redeemed. One of the other things that we see with index funds is there are, in many cases, unknown transaction costs. And this is because when an investor invests in an index fund, the manager has to buy or sell the underlying unit in every case. And this action of buying and selling the underlying units that are in the index means that all of the investors in the fund suffer from the price impact. So a lot of index funds will have anti-dilution or swing pricing mechanisms on them, which protects the existing investors from the impact of new investors coming in or existing investors leaving the fund. And that means that you don't actually know, because many of them have a threshold before that applies, you don't actually know the transaction cost that you will pay in terms of dilution or swing pricing on an index fund. But where index funds do have some advantage is that in many cases they do trade down to fractional levels. So 4 decimal places is pretty common in the UK, which means that they can work better to smaller account sizes and allow investors to get more fully invested, assuming that there's no investment minimums on the fund itself. The other vehicle, and one that's a little bit more of a slightly more technical vehicle, certainly a newer vehicle, something that sort of came to the market around the late 80s, early 90s, was the rise of ETFs, which are exchange traded funds. And these have a lot of the features of an index fund, but also have a lot of the features of a listed security, which gives them many advantages over traditional index funds. A couple of them advantages are things such as being continually priced during market open hours. So they are listed on exchanges. You can buy and sell them on the exchange itself. And they do have a NAV, but they also have a live market price. And generally that live market price should be very, very tight to the NAV due to something that we call the arbitrage mechanism. Now, the arbitrage mechanism is basically provided by the fact that there's 2 layers of liquidity with ETFs. You have what's called the primary market, and that's where authorized participants can create or redeem units. They can literally go and buy the underlying securities, give them to the fund issuer, who will create the units for them, and then the authorized participant can then sell them. And they can also do obviously the opposite side of that trade and redeem them. But you also have, as I say, the secondary market, where they are traded on exchange or OTC directly with other investors, and there's no creation or redemption units. So the fact that them 2 different layers of liquidity exist means that the NAV should be kept very, very tight with the market price in most cases, because if there's any sort of differential between the market listed price and the NAV on the fund, authorized participants can step in and arbitrage away that difference for their own profit. One of the other benefits of ETFs is that because they are traded on exchange, you don't suffer from time out of the market if you trade on the exchange or directly OTC. So if you were switching out of one fund and into another, and it was in an index fund form, you can suffer from the fact that they have different dealing points and different NAV points, and there is a point where you're not in the market while you're waiting to be given a price on the fund investment that you've made. If you buy and sell an ETF on an exchange, it's exactly like buying and selling a security, a stock, an equity, whereby as soon as you complete that trade, you are basically exposed to that position. So there's no time out of the market if you're trading on exchange. There is if you do something that's called like a NAV trade, for instance, with a market maker or an authorized participant, but that's slightly different. But ETFs do allow you to basically minimize your time out of the market when you're switching and changing funds. One of the other benefits is known transaction costs. So a buyer will pay a market spread on the exchange, or they will pay a NAV plus bippage cost if they want to create or redeem units. And this means that existing holders are not impacted by the transactions of new or leaving investors. And that means that there aren't dilution or swing pricing mechanisms in play that are needed to protect existing investors, which is very good when you get that transparency of knowing exactly what a trade's going to cost when you first do your investment. But one of the downsides of ETFs is that they do trade in whole units only, being listed vehicles, and they're not fractionally traded on exchanges, although some platforms can facilitate fractional trading. Generally, they are traded in whole units only, particularly in the UK, and that can make, depending on unit price, ETFs somewhat difficult to use in smaller account sizes. So a bit of thought has to be applied to the unit price on the products if you are owning ETFs in, say, a multi-asset portfolio. At AJ Bell, we prefer ETFs because there's democratic pricing, there's a single price point for both retail and institutional investors. We appreciate both dual sources of liquidity, the primary and secondary markets, which allows us to be a lot more flexible in how we do rebalance and move in and out of funds. That also allows us to do continuous trading, so we can trade back to back when we do switch. Transparent pricing, the costs are known to us at the time of the trade with visible bid-ask spreads, which we think is a benefit. And generally, ETFs are where the innovation is in investment, in passive investment. We're seeing more products come out related to sectors, themes, duration targeting, and fixed income alternatives are all coming to market generally in ETF formats as opposed to the older index fund vehicles. So we have a broader, sort of menu of options that we can use in the portfolios if we generally prefer ETFs. And in many jurisdictions, the ETF structure can lead to tax advantages over index funds. That's particularly the case in the US, but it's certainly, obviously, it can be the case as well in other jurisdictions. But in the US market, ETFs have a massive advantage in terms of tax compared to index funds because of the way that they can move in and out of positions and avoid capital gains tax. That being said, we do use index funds at AJ Bell where the cost advantage is significant. If the platform frictions mean that we require fractional trading, we may use index funds for that reason. And sometimes index funds do also have tax benefits over and above ETFs. So there are reasons and times where we'll use index funds, but generally at AJ Bell Investments, we have preferred ETFs in our portfolios. Once you've decided on what the appropriate vehicle to pursue an investment, a passive investment strategy is, one of the other things then that you need to think about is how does that passive fund replicate the index? So there's two main ways that funds will replicate a benchmark index. The first is a physical replication, which means it owns all or some of the actual names in the index itself. And the second and less common one is a synthetic replication, whereby a fund will use a swap to basically receive the index return in exchange for owning a basket of collateral that it pays the return of that collateral to the swap counterpart. So if we look at firstly the synthetic graphic that we see on screen right now, we have a synthetic ETF, which, as I say, is swap based. It will use the cash that investors have provided to buy a basket of collateral. It will give the return on that collateral to a swap counterpart, and the swap counterpart guarantees to pay the index return for whatever the benchmark index is to the synthetic ETF. So generally we see a lot of banks who act as swap counterparts to synthetic ETFs. However, there is some credit risk in this arrangement. You're relying on a counterparty to pay you the index return, and many investors in Europe particularly, and particularly in the UK, have decided that they prefer a physical replication over a synthetic replication. It's easier to understand, it's a lot cleaner. The index says own XYZ securities and the fund owns XYZ securities. So looking over at the physical replication side, how do funds do physical replication? There's three main ways. Generally in equities, we see funds generally do full replication. The benchmark will have a list of securities that make up the index. The fund will own all of them securities to the same weights as the index specifies, meaning that the fund then should track really tightly to what the index performance is. In fixed income, we see slightly different approaches because fixed income indices are generally much broader, containing thousands of bonds, and not all of them bonds are always available or liquid. So the two main ways that we generally see fixed income products, and in the case of some emerging markets or global products, they will use what's called sampled or optimized replications. Sampling generally means that the fund will divide the index up into maybe sort of sectors, and rather than owning every single business in that sector, they think the sectors will generally move similarly. So we'll own maybe the largest 5 or 6 names in that sector within the index itself, and as long as we own enough and we have a good sort of approximation of what the index looks like, we should get very similar performance. An optimized approach will do similar, but it won't necessarily do it where it'll own all of them in a similar proportion and try to be pretty even across the board. An optimized replication will try to basically say, okay, where are we most exposed if we don't own something, or where it has the least impact on the actual index return, or which products are the least liquid, and let's exclude them. So it's trying to arrive at the most efficient way to get the index return without owning every single security in the index. So there's two different ways to do it, but it's important that you're aware of, how the fund actually replicates the index that it's purported to track, and that investors are comfortable with some of the trade-offs that are being made, particularly if it's a sampled or an optimized replication. Generally, with a full physical replication, it's a pretty simple case of just owning everything. So it's less of an issue, but certainly when there's a sampled and optimized replication, you do need to be aware of how the manager is doing what they're saying they're going to do. So there are two factors that are quite important when you're making your first decisions as to which index fund or ETF you're going to use. A couple of other things that are quite important when you're looking at ETFs and index funds is thinking about costs. Now, I think many people think passive investing, and thinking back to the title of the slide deck, passive investing is not passive. I think many people think you can buy an index fund or an ETF and you just choose the lowest cost product. Once you've bought your product, it's a set and forget, and you don't really need to think about replacing it or really doing anything. It's passive, right? You can just sort of let it run. One thing that I think has to be made very clear is that there's more to selecting an appropriate passive product than just ETF, than just OCF. So many products will have low OCFs, but if they are not well traded or not very liquid or don't have large AUM and investor interest, that means not many people are transacting them on secondary markets, which means spreads can be very, very large in some instances. And in many cases, given where passive investing funds have moved to on OCF basis with very low costs generally across the board now in terms of single and very low double-digit OCFs, the spreads can now be multiples of the OCF that an investor would face. So it's very important that whilst the OCF is generally being the biggest component of cost in terms of an index will deliver a return, and a fund that should deliver that same return minus its OCF if it's doing its job well, that now is in many cases superseded, as I say, by the spreads that we're seeing on exchange. And this graphic just is a very, very simple example, really. So this just takes the largest 100 LSE listed pound priced ETFs in the market, and it looks at their OCFs against the time weighted spreads over a period of the last week. And which is pointed out with the two red dots, you can see both of these products track the same benchmark index. They both track the MSCI World Index. The one on the far right is quite low priced in terms of OCF with a 19 bip OCF. But to go and trade that in the market over the last week, it's seen average spreads of almost 60 bips. And when you think that spread is basically 3 times what the OCF is, that's a very, very high frictional cost of buying in and out of that fund. If you look at the red dot on the left, it does have a higher OCF. It's sat at 30 bips OCF, so it's 11 bips more than the first dot. But when you look at the spreads that it's seeing, that sits around 16 bips. So for an all-in round trip cost, I could buy and sell that fund and hold it for a year and look at approximately 46 bips of cost in total, compared to the first one that we looked at, which if I bought and sold and held it for a year, I'm probably looking somewhere around 80 bips. So almost twice the price, even though at a headline level, the OCF looked lower on the one on the far right. So it is really important that you don't only look at the OCFs, you do also look at the frictional costs of ownership, spreads with ETFs, but also anti-dilution and swing mechanisms on index funds, which are trying to do the same thing, basically cover the cost of actually transacting in and out for a new or a leaving investor. So OCFs are very, very important, but certainly transaction costs, spreads, dilution is also a very, very important factor in terms of how much it's going to cost to buy and sell an index fund or an ETF and own it. So do pay attention to not only the headline cost. Once you own a index fund or an ETF, there's a couple of things to think about in terms of, is the fund doing a good job? So there's two sort of measures that sort of dominate in passive investing as to whether a fund is doing what it's meant to do well. The first one is what's known as tracking error. And what tracking error attempts to measure is the variability of the performance around a benchmark. So as you can see on this graphic, if the index had a benchmark average return of the red dotted line at the top, then there's a blue fund, Fund B, and then there's one that's got a pink band around it, which is Fund A. If we look at Fund A, it has wider tracking error, so the range of performance around its average is wider than we see in Fund B, so it has larger tracking error, but its actual return to the benchmark itself that it's trying to track is closer than that seen in Fund B, so it has better tracking difference. And these two distinctions are quite important. If you're owning a product over a shorter timeline, maybe less than a year, tracking error is probably more important in terms of whether a fund is doing what it's meant to do well, because you want it, on any time that you may be coming out of that fund, if the range of outcomes is much wider than the benchmark, you might end up buying underperformance or owning underperformance. Similarly, you could get some overperformance, but that's not necessarily what you're looking for in a tracking strategy. If you're owning a product for longer than a year, you're probably more, or you should probably be more concerned about tracking difference. And that means over longer time horizons, the variability around the benchmark return is less important. And what actually matters is how far under or above the benchmark have I actually performed. So the benchmark return minus my fund performance is tracking difference. And over longer horizons, tracking error sort of falls out in terms of importance, and tracking difference becomes more important to an investor. So these two measures are both used very widely across the board, but they are different and they do seek to measure different things, and understanding what tracking error shows and what tracking difference shows is very, very important when you're assessing how well a tracker fund, whether it be ETF or index fund, is doing against its actual comparative benchmark. One of the other things that is important to understand when you're selecting passive products is the domicile of the actual fund itself. And that basically is, where's the fund registered and what's its jurisdiction that it's registered in. So it's not where is the fund investing. It's not a MSCI Japan fund. It's where is the fund that is investing in Japan actually based. And that's going to determine a lot of the tax treatment on the fund, and how withholding tax and things is actually, sort of calculated for the end investor. And it can make a large difference on performance depending on the tax treaties that are in place between various jurisdictions around the world. So in this example on the screen right now, if we look at, say, two index funds, one that's a UK domiciled index fund and one that's either an Irish domiciled index fund or a Luxembourg domiciled index fund, which both have the same level of withholding tax on Japanese dividends. The UK domiciled fund would see withholding tax on dividends of 10%. The Irish or Luxembourg domiciled index fund would see withholding tax on dividends of around 15%. If you're investing in Japanese stocks and the index dividend yield is 2.5%, which it is roughly around that point at the moment, the UK domiciled index fund, if it done exactly the same as what the Irish or Luxembourg one did, would see a 12.5 pip annualized performance uplift, just on the back of the fact that it has a more favorable tax treatment for withholding tax on Japanese dividends. So if all else being equal, then two funds were pitched against each other, the same OCFs, the same spreads, the same investments were made, the same rebalancing schedules, everything was exactly the same, the UK domiciled index fund would outperform the Irish or Luxembourg one quite significantly in passive terms, 12.5 bips. just by the fact that the UK has a more favourable tax treatment on dividend withholding tax. So understanding where your fund is domiciled is important and is something that has to be considered depending where you're investing, where, you know, what tax treaties are in place. So definitely something to think about when you're choosing a passive product. And there are then some other considerations that you need to think about, which I've put them into one slide, but that doesn't mean they're any less important. One, securities lending is very, very common on passive funds now. It can help boost performance or reduce costs to end investors, but investors have to be sure that they're comfortable with the lending standards that are being applied on any securities lending program, and they should also be aware of how the fees are distributed back to the investors. In some cases, the use of all securities lending programs generally use a lending agent, and in some cases the issuer of the fund is also the lending agent, which means that they're also boosting their fees from that overall investment strategy by taking a fund fee and also by collecting fees from basically facilitating a securities lending program. Another thing to be aware of on securities lending is that the collateral being posted by borrowers matches the investment strategy of the fund. If anything did go wrong and the securities lending or loan was not returned, the collateral then becomes the property of the fund. But if the collateral that's being provided is, say, illiquid bonds, and you're invested in a emerging market equity ETF, which has been doing securities lending, all of a sudden you have a mismatch in between the strategy you're invested in and the assets the fund has lent out and the collateral that you've received when the lending has gone bad, which then has to be sold and suffers frictional cost. And if you held on to it, it doesn't give the performance that you're looking for or the fund will be looking for from the assets that it holds. So it is important that collateral matches the investment strategy of the fund. Another thing to be aware of is comparing performance can be difficult on a like-for-like basis with ETFs and index funds. Certainly over shorter time horizons due to the lack of commonality on the benchmarks that are being referenced by the different funds, and also due to the difference on NAV points. It's a bigger issue on index funds because a NAV point is all you have to measure how the fund's doing. Slightly different with ETFs where there is a market price, which if they're listed on the same exchange, they'll have the same close prices. But with index funds, you have a single NAV point and the index valuation point might be different to where that NAV point is in terms of timing. And as a result, you can end up with difficulty when you compare and tracking difference from a fund to a fund because different funds have different NAV points in terms of timing. And then you have different indexes as well, where they might have slightly different times that they actually price the index. So it becomes difficult on short time horizons to really do an apples to apples comparison of performance. Similarly with tracking difference, like I mentioned earlier, over longer time frames, that should fall away a little bit and become less impactful, where the small differences in timing start to become a smaller part of the actual performance story. So comparing performance over longer time frames is better than short, but it is something to be aware of when you're comparing a fund to another. And then one of the final things to think about is what fair value policies exist on the fund. Even funds that are very similar and track the exact same index can have very different policies around fair value. And what fair value means is that when markets are closed or the fund is closed and the price has been basically generated, but some of the jurisdictions that the fund invests in are still open, there is a price in the market for them, particularly on something like an ETF. And the manager should be looking at the underlying assets that it owns and fair valuing them so that the investor basically receives a fair price for the assets that it owns. Just because it may be closed in the home market doesn't mean that the assets are not being traded and changing and fluctuating in value in other jurisdictions. And this is particularly important on things like emerging markets or global strategies where markets are open at different times. It's important that you understand a fund's fair value policy, because one fund may say it does fair value but it doesn't, and another one may and actually does do the fair value, and that can make a big difference depending on whether the NAV that you're seeing is what's considered stale or fresh, alive NAV, which takes into account some of the fair valuing. So understanding what the fund does to make sure it controls for that is quite important. And then ultimately, when you think about how to build an approach for selecting passive funds, there's two sides to it really. There's a quantitative side, which are measurable things that you can use to guide a choice. How does the index fund replicate? What's the OCF? What do the dealing costs look like? What does the tracking look like? And there are more qualitative elements. So that's, what's the index that it's tracking? Is it a sensible index that doesn't have a lot of turnover? What's the securities lending policy? What's the provider's market commitment? Is it a small fund? Has it got big AUM? Do they have a strong presence in the market and not going to close the fund that you're invested in? So there are two sort of wings to the process, quantitative, as I say, and qualitative. And then once you've the elements that feed both of them two sides, the process to building an approach is basically to identify a suitable index that represents your asset class. There are lots of indices available, and something to be aware of is some of the main ones, the MSCI and FTSE indices, do not quite categorize developing and emerging markets exactly the same. So even two indexes that are very, very similar, something like the FTSE World and the MSCI World, will actually have pretty big differences in terms of some of the underlying countries that they invest in. So that choosing a suitable index is important. Once you've chosen your suitable index, then you look to identify the most suitable wrapper with which to affect your investment. As I've mentioned, there's index funds and ETFs, both available in the universe, very widely, both very low cost, and lots of choice. You then need to identify an asset manager that's got suitable scale and expertise that you believe can replicate the index well, and you want managers that are committed to your particular market and have scale and, as I say, expertise. And then you can go and choose a suitable product on some of the other measures, things like OCF, things like spreads, things like the security lending program in place, which is going to give you, as I mentioned on the first and second slide, it's going to allow you to minimize the tracking difference and that you see between your chosen index that you want to track and the actual fund that you end up owning. Investable universe continue to grow in passive investing. There's new entrants coming into the market, predominantly in ETF form, as I mentioned earlier, but there are still some new index fund issuance coming to market too. But it is important that in any selection process, you are pragmatic and understand the nuances between the different wrappers, the different indexes, how the funds replicate, the factors that will impact your total cost of ownership, which are things like OCF, spreads, dilution policies, securities lending policies. And once you've completed that process, because competition has driven costs lower, we're now actually seeing costs are not really where issuers are competing. In a lot of instances now, they're trying to differentiate on indexes or securities lending or very, very small tweaks to the actual benchmarks that they think make their funds more marketable. And that does mean that regular reviews of your holdings are needed. As I mentioned at the start, passive investing is not passive. Whilst it may be rules driven and rules based, there is still a very sort of onerous due diligence process that has to happen to make sure that you are in the most appropriate vehicle, you are getting the tightest tracking available, and you are getting the most efficient representation of your chosen investment strategy. We do have a fully formed passive research process. As I mentioned at the start, I'm the senior research analyst in AJBL Investments Research Team. I focus on passive research. So we do offer a range of passively implemented products, both in MPS and fund form, from the AJBL Investments range. Our approach basically goes through all of the steps mentioned. It's a multi-layered approach designed to find the best passive implementations, whether they be ETF based or index fund based. We do have a very, very robust due diligence process, which allows us to filter what is a very, very broad, dynamic and rapidly evolving universe, and arrive at what we think are the best funds out there today. We do use, as I mentioned, a blend of quantitative and qualitative research processes to allow us to try and find the most efficient product, not just on a cost basis, but also on a performance basis in terms of tracking to our desired benchmark. And we do provide on all of our passive range continuing oversight and monitoring and engagement with issuers on any of the selections that we own, but also on the wider marketplace to ensure that we're always aware of new range developments, tweaks to products, index changes, and any new issuance that's coming to market that may present a better option than the one that we're currently using. So, we do think we have a very, very strong research process at AJ Bell Investments. And as I say, there is a pretty broad range of passive options within both our MPS and fund ranges, including both growth and income strategies. So, if you do have a passive investment mandate and you are struggling with some of the research, we do offer products to the market which can help. And if there are any sort of questions or any information needed on how we do what we do, you want further information or you want to hear about the AJ Bell investment range, do just reach out to your AJ Bell Invest Centre representative who can basically put you in contact with the AJ Bell Investments team, and we'd be happy to speak to you about your passive investment needs. Thanks for joining me today, and hopefully that was useful. Have a great Christmas and New Year. See you in 2023.
Thank you, Terry. It's time for a short break, so grab yourself a top up from the coffee pot and we'll see you back in 5 minutes. kicking off part 2 is our penultimate speaker of the morning, Elliot Date, Regional Account Manager from Fidelity International. The decumulation game requires a dynamic strategy is the title of our next presentation and addresses the moving parts affecting retirement. Some of these you can control and some we must contend with, but all elements require strategy, forethought and flexibility to help plot the best course of action. Looking at the measures needed to address inflation and longevity risk and digging into the sequencing risk. Ladies and gentlemen, Fidelity International's Elliot Date.
Hello, good morning, good afternoon, wherever you are in the world. For those of you that don't know me, my name is Elliot Date from Fidelity. For the next 25 minutes, I'm going to be your host of our very own game show. Now, it's a game show I've called You've Got to Speculate to Decumulate. I'm not sitting here, though, saying there's anything speculative about retirement. As did you know, there's 12 million people over the age of 65 alive in the UK today, but 1 in 5 of them doesn't have a retirement plan. And on top of that, we know that 4 out of 5 advisors are saying retirement planning is the most important aspect of the financial planning journey they give to clients. It isn't all plain sailing though. We've got a cost of living crisis, markets continuing to lag behind, and regulation increasing as well. But don't worry, because as we go through the show in the next 25 minutes, I'm going to play out little snippets of hope for all of us. So with that, let's hit the lights, get the cameras rolling, and get this show on the road. And what sort of game show host would I be if I didn't start with a little bit of the big pension quiz, which is what I've called this, which is very simply, I'm going to ask you a question such as, in which year did the UK inflation first pass 10%? Quick couple of seconds just to have a rough guess, but if you weren't writing down too quick enough, maybe you're thinking maybe the 70s. It's actually 1915, so that's now our benchmark. Now what I'm going to do is ask my next question, such as the Bank of England introduces the first workplace pension. I'm going to ask you just to write down on a piece of paper either higher or lower than 1915. So Bank of England introduces the first workplace pension, couple of seconds, higher or lower than 1915. Well, I can hear you probably writing through the screen. You're definitely saying lower, which is 1739. To give yourself a big tick for that one. We then go to my next question, which might be a bit easier. So the average UK life expectancy goes above 70. Now, is that higher or lower than 1739? Now, I can feel you all screaming at me. Higher, of course, it's 1960. So my next question is the first SIP proposed by Nigel Lawson, higher or lower than 1960? Couple of seconds. That we can all probably agree though the answer is higher, 1989. My next question is the 8A pensions simplification is introduced. Now I can hear this resounding noise coming through the camera at me saying higher, 2006. And I'm going to ask you maybe an easier question now. I feel like everyone's going to know this. Pension freedoms, no marks for this one if you're saying higher, 2015. But little curveball thrown at you now, and that's with the 4% withdrawal rate Trinity study is published. Is that higher or lower than 2015? Couple of seconds. Appreciate it's a bit of a curveball. Excellent. As you're writing down lower, you were correct. The answer is 1998. And then finally, my last question is the workplace pension becomes compulsory. Higher or lower than 1998? And I can hear a resounding higher being put through the camera with 2012. So thank you for playing along with that. Give yourselves the score. There are no prizes today other than that prize of satisfaction knowing you got them likely all right. But let's leave the game show behind now and get straight into the meat of the show. And it's going to be guided by our learning objectives. We're going to start looking at the decumulation phase and sequencing risk in your retirement, but then going to take it up a level and look at the long and short term themes for clients, but most importantly, how we can tackle them in retirement. And I'm going to put it all together for us and consider where these attractive investment opportunities lie and where we can fit them in to a solution. So that's the roadmap for the next 20 minutes or so. However, it's fair to say that a number of the themes you're going to see on this presentation are not brand new, but they have just simply evolved. A bit like people's worries around retirement. Now, what I've put here is a picture from the 1800s saying, I can't afford to retire, showing that even in the 1800s, people were feeling the exact same, saying they needed their money to go further. But bear in mind, this was a time where your retirement age, because you likely your life expectancy was only 45. And if you made it to your early 50s, you were considered to be extremely old. Now, we know in the UK today that's not the case, with the average life expectancy being 82 and going up year on year thanks to the advancements of medical research. But what has it meant for our money? Well, I've charted here the regular withdrawal amounts taken out by pot size for pensions. And very simply, what you're looking at is, of course, the pensions from £10,000 or less on the far left, all the way up to 250,000 or more. Now, two things to note when you're looking at this. The average UK pension pot sits slap bang in the middle at £50,000. And then take a second and think about your client bank, because I'm sure they sit much more so to this right-hand side of the screen at 250,000 or more. And I also think that's reflected when you're seeing these withdrawal amounts being taken at a much more manageable levels. Now, the key takeaway here is that taking capital out remains a favourite amongst the advisory community. But in volatile years such as this year, where markets are down about 20%, it can cause a real headache and be a real challenge, particularly when you're thinking about what side of the journey you're on when you're talking to clients. Because for someone like myself, if I was a client of yours, I'm sure you'd be sitting where, Elliot, you're 28 years old, you've probably got another 30, 40 years ahead of you in the market and also in working life. So actually, markets being down 20%, it's no bad thing. I can get that money in working for me for a long time period versus someone on the other side of it who maybe said a bit like this year, I want to retire, want to start to that decumulation side and start to draw down on my capital. Well, we now need to start thinking differently, because in the last 10 years, this hasn't really been a challenge. And if you look at that average 60-40 portfolio, the last 10 years, it's returned just over 12%. But now what we're seeing is that this year alone is down 13%. So we know we need to start thinking differently about the portfolio and some of the assets we can use. But really, I think it simply breaks down to why it matters and when we need to get into the details and get under the bonnet. So what I've put is put two portfolios in front of you, portfolio A and portfolio B. You can see both of them look the same in terms of expected return and volatility. But then we've got this yellow bar, this average worst 5% I've highlighted here. Now, that's because statistically, even though these portfolios look the same, until we get into the details, you can see actually they're very slightly different in terms of their worst outcomes, because 95% of the time, these portfolios can be anywhere from -20 to a positive 28%, telling us that steady 4-5% we want in retirement is a bit harder to come by, because we know as an industry we focus so much on volatility, this meat in the middle, but the real risk in retirement comes from that tail risk, this red bar at the bottom. This is something I'm really trying to explain to my parents at the moment who are approaching retirement age and trying to get them to go and see and have some financial advice from a financial advisor. So I was not afraid to say, when I went for a coffee with them a couple of weeks ago, I actually used this slide with them. Now, very simply, what I explained to them was there's two retirees, retiree A and retiree B, both of whom have £100,000 to start off their retirement. They're going to take out £5,000 a year to support them throughout, but they're also going to grow at 6%. However, they're going to have very different market journeys. Now, we look at retiree A, they're going to start off this year with their retirement with 3 negative years in the market, a bit like someone who might have chosen to retire this year. But at the end of there, for the last couple of years, they're going to see double-digit positive investment returns. But when you're looking at that chart in front of you, you can see that actually, even by year 20, there is nothing left. Versus retiree B, who has a few mediocre years, nothing stands out, but still sees double-digit negative returns for the last 3 years of their retirement, still has more than doubled their capital from when they started. So we know we need to start thinking differently around the assets that we use, because people are living longer than ever before, and people are living to be well over 100 across the world. So you might think, well, post-COVID, Elliot, that's because people are smoking less, drinking less, exercising more, just generally being healthier. But what I thought was I'd go straight to the horse's mouth and hear from them directly. So I watched a BBC interview where it's called Secrets of Living to be a Centurion. And I've got my two favorites written down for you here. And the first one is, the secret to living to 100 is 3 bottles of beer a day and a glass of whiskey before bed for 70 years. So I thought, okay, maybe I could do that in my life. And I'm not joking about this one. This one is, now I promise you the real secret to living to 100 is, don't get married. It's just not worth it. So I speak as an unmarried man. Maybe I'll keep it that way. But we know that people living longer is a great opportunity for advisors, particularly when you look at this silver economy. And I've charted here, this is the average spending power of that 60-year-old versus the spending power of the average 30-year-old. And in the last decade, it's more than doubled for the average 60-year-old. So there's going to be more clients out there needing more high quality financial advice. But I mentioned at the beginning, it isn't all plain sailing though, because we actually do know that regulations continue to increase as well. Now I've put here consumer duty, which I'm sure has kept all of you busy towards the end of this year, and I've put it as deal or no deal. And that's because I think we actually are going to have to deal with this. There's no way you can just say no deal and outsource this. But I think it starts, to my mind, with asset managers and IFAs working together. And of course, we think by products and services. I think about sustainable funds, ESG funds, which sit with ourselves here at Fidelity and make sure there's no risk of greenwashing and doing what these funds say on the tin. But of course, then it comes to price and value, which is where advisors, in my mind, start to come into the play, because we need to make sure our opportunities and our funds are priced attractively, but also for advisors to help clients understand the price they're paying for advice, but also the value that they're getting, and explaining and helping them understand complex themes such as decumulation, sequencing risk, taking them on that journey and then supporting them throughout, which when we put it together, we know that we start thinking differently. People are living longer, and of course with regulation increasing as well. Now I don't have a big red button on this webcast, but let's say I do hypothetically, I hit it, the sprinklers are going off, the confetti's coming down. But now I really want to get into the detail. What's the main concern for clients in retirement? And I was reading the latest survey from AKG, which surveyed 2,000 financial advisors. And of these 2,000 advisors surveyed, I said, what was the main topic of conversation with clients over the last 12 months? And you can see market volatility and rising long-term inflation there, which I feel probably is very well reflected, and probably maybe nodding your head through the camera talking to me. So when you're looking at that though, I wanted to pull out that of the same survey, so of 2,000 IFAs, 47% of the advisors said that because of rising long-term inflation, they felt clients were sitting on their hands more and choosing not to do anything. So that's where I want to start our journey here. There's no inflation is back in a big way, because we saw the headline figure coming in at 11.1%, which is the first time for many of us as investors and having to reset our expectations, as it's the first time we're having to invest in an inflationary world. Now I've charted here the consumer price index dating back to the 1970s, broken down for a number of regions across the world. You can see that really inflation hasn't played a part in our lives since the early 90s. This big spike up on the right hand side, which really was fueled back in 2020 with the rise of the COVID pandemic and the supply chain disruption issues that we saw, these boats being stuck in canals and oil tankers being stuck off the coast of California. And I remember these news stories, I'm sure all of you do as well. We then had central bank liquidity, very different to now, constantly pumping in QE, keeping those markets propped up. And now even in the shorter term, higher commodity prices from oil and gas. But at Fidelity, we're of the view that inflation has peaked and is going to come back down to much more manageable levels. And we look at this on a couple of technical factors. We start by looking at the ISM and the PMI, so Institute of Supply Management, Price Manufacturing Index, both of which are leading indicators on global growth and have just turned negative for the first time since April 2008, showing a slowdown is coming in. But why that's important to be aware of with inflation is that the main driver of inflation comes from consumption. So as households are forced to focus on the rising essentials and not so much on the luxuries, that's going to start to curtail it much more. So we see inflation coming back to much more manageable levels of sort of 3, 4, 5%, not these double-digit numbers we're getting used to. But I mentioned there that households being focusing in and dealing with inflation. Well, you might think the one area that's coming into it, of course, is coming from food inflation. Well, the UK inflation is up at 32% for a weekly food shop, but I've charted just actually the UK is a bit more sheltered versus other areas of the world when you look down that list to places like Pakistan and Nigeria. But the way I simply think about inflation is that it comes in a couple of waves. And we start with what we've already seen, which is shrinkflation, producers capitalizing on shrinking assets and shrinking their units, but of course keeping the price the same. You've probably seen this in your daily lives. Gone to the supermarket, picked up a bag of Skittles. There's more air in that bag than there are Skittles. And then we then get to my next wave, which is what I call sneakflation, which is something I've only just started to see. So I was at the Comedy Store in London with a couple of my mates recently. Now, be aware if you are going, because they're pricing beers in 2/3 of a pint. So that means when you pay for a pint, you're actually paying a very different price to what's advertised. Now, it can be a real challenge to work out the real cost of a pint, particularly when you've had maybe one too many, but I wouldn't recommend trying to work it out then and there. But we know that businesses are trying to be creative, and it isn't just the hospitality industry. Even things like BMW are now implementing if you buy a brand new car, an £18 a month subscription fee to have a heated seat in your new car. So we know businesses are trying to be creative, and I was thinking, well, what can I do to bring it to life for you? Well, I've put here from Romano's Macaroni Grill a temporary inflation fee. Now, this is just showing how businesses are trying to deal with it, because inflation is back. But what can we do to protect ourselves and start thinking about our portfolio? Well, we know it's going to have a knock-on effect on our nominal return, which is our headline figure, but also more importantly, our real return, that orange line there. Now, if I look at that 60-40 portfolio, I've drilled it down to what you can see in the 1970s when I compared it previously. This was a time where your headline figure was 9.2%, but that real return, the bit that matters, was just 1.6%. Versus the last 10 years, you can see the disparity coming in there. So we know inflation's back, it's going to have a knock-on effect on our portfolio. Well, what are the assets we need to start using inside of it? Well, I think we're thinking about retirement and also the defensive area of the market. So let's start by thinking about fixed income, as there's 5 key thoughts I think we all need to be aware of. I think it starts by understanding that central banks have a real challenge on their hands, thinking about balancing growth and inflation. Now, we know they've continued to raise rates and are now signaling, particularly in America, they're going to start slowing the rate raising cycle. However, I think the way I think about central banks having to deal with inflation is that you've been on a flight with a very inexperienced pilot. Maybe it's their first flight, having to fly out with the passengers on. You've had a really choppy flight, but as you're coming into land, he comes on the speaker and he says, "Don't worry, everyone. I'm going to attempt a soft landing." I'm not sure how I would feel about coming into land. That's what I feel central banks have to deal with inside of it. But what does it mean for our fixed income? Well, I think it's going to continue to offer a portfolio diversification aspect. Simply, I think it breaks into 3 key pillars. Your fixed income should be offering you an income. There's no surprises there. It should be offering you safety in volatile markets, which hopefully you will felt throughout at least the first half and maybe even the second half of this year. And then last but not least, and most importantly, the diversification away from equities. And from our analysts saying 5 to 6 years duration is the best negative correlation to the equity market that we've seen. So be aware, for 6 to 5 years is the best negative correlation. But I do think actually that higher yields are here to stay and is going to benefit retirees. We know it's already impacted the annuity market beneficially, but also we've seen 13 trillion negative yielding debt wiped from the market. But this is where active management, I think, really comes to the forefront. From a governance perspective, make sure businesses continue to pay those debts off. And to my last point, I actually think this is a new area coming to the forefront, and that's the bond market's role in financing the new economy. And that's looking at new products and new projects like blue bonds, green bonds, social bonds, and moving much more towards a sustainable world, and how the bond market can help finance that will be crucial moving forward. So you're probably sitting there thinking, well, Elliot, this is great. We've covered fixed income, but what about equities? That sweet part of my portfolio, 60 to 70% of it. Well, we know it's been a real tough year across the market. And I've put here broken down from a number of regions, etc., just to show that there's been no safe place to hide other than oil and gas. But even this is now starting to come in as we see huge price rises in that area, which of course brings a lot of producers online, keen to capitalize on the higher price, which then oversupplies the market. And of course, we've now seen gas down 40% from its highs earlier this year, and oil continuing to fall day after day at the moment. But we have seen a lot of fear back in the markets. The MSCI's All Countries World Index seeing its quickest sell-off since its creation in 1995, and global bonds having their worst year since 1776. And it's all really been brought to the forefront because of the rise of geopolitics and that volatility in the market. So I've charted here the geopolitical risk index dating back to the 1970s. You can see a number of conflicts in front of you, and that horizontal line shows the risk sentiment line. Now, the key part here to be aware of is when that blue line pierces through it or touches it, markets sell off about 20%, which is where we are at the moment on average. But 12 months later, they've made back this initial 20%. Because we know markets are constantly forward thinking. So we've now seen this elevation because of the rise of the Russia and Ukraine conflict, which has been terrible. But we now see China and the US also starting to clash over Taiwan. And I was reading the Rand Corporation study, which what would it say hypothetically if we were to see a war based in GDP for either America or China. Start with America, we'd see sort of 5 to 10% wiped from their GDP with a war with China. So bad, but not terrible. However, you then look at China, the world's second largest economy, expected to be the world's largest economy in the market by 2050, would see nearly 35 to 40% wiped from their GDP with a war with America over Taiwan. So we know it could be catastrophic for the growth engine of the world, which is why we're seeing a lot of volatility back into the forefront. And I was thinking, well, when I was building this presentation, well, how could I bring to life how the real retail market is feeling? So I was on the Wall Street Bets Reddit community looking for a subreddit that I could pull into a presentation. So I'll give you a second. Is there any guesses right down as to how clients are feeling? So I saw this and it says, how do I blank from stocks? Well, just while you're writing that down, be aware that while I'm writing it, it's actually taken, it says, how do I take the money back from stocks? And this was a subreddit that said, I've decided stocks aren't my thing. Is there any way to get my money back, bracket, like a refund? Someone said, well, you can sell the stocks. They said, I don't want to sell the stocks. I just want my cash back. Is this the only way? They said, yes, this is the only way. There's no refund policy on stocks. And maybe an advert for someone that definitely needs some financial advice. But we know with volatile markets, particularly in the equity market, I think there's 5 themes for all of us as investors we need to be aware of. And I think we need to start by recognizing that the previous 10 years were fantastic. Passives have done extremely well. But now when we look forward for the next 10 years, we need to start thinking differently. And that's where I think active management is going to continue to prove it is alive and well. And we're seeing the rise of value strategies capitalizing on this volatility, particularly from the tech sector. But also when we think about volatility, I'm always reminded of Benjamin Graham, Warren Buffett's mental saying, remember the market is there to serve you, not the other way around. But also remember that diversification is beneficial, but also that growth is not the only way and tech is not the only answer. And now is the time, as in a great inflection point, to start to add some value back into it. Don't go away and sell your Bailey Gifford North America. Don't go and sell your passive funds, but be aware when you're reviewing your portfolios, now is the time to start to add some value back into it. And also pay attention to geopolitics. It is going to matter more as we move forward. And I do think there's a great book out there which you can get for about £20 on Amazon, which is Principles for Dealing with a Changing World Order from Ray Dalio. It looks back at history and the rise of rising superpowers and the fall of them, and of course how it conflicts over time. So I would say Principles for Dealing with a Changing World Order I would highlight for looking into geopolitics a bit more. So those were our 5 key thoughts. We've covered fixed income, we've covered equities. Now let's put it together and start by thinking about that 60-40 portfolio. Now you can see I've broken it down here in front of you. I said it's having its worst year, being down about 12%, which is its worst year since 1935. But when we are looking at the 60-40 portfolio and we are looking forward for the next 10 years and thinking differently, I'd expected that alternatives bucket in green continue to grow, but also sustainability playing a much bigger part in it in our lives. Now, I can only mention sustainability can feel a bit like deal or no deal. People saying, what do you want to do? Well, if you said no deal for the last 12 months, you've done it extremely well. Now it's because I've charted here the returns of a number of funds actually showing really what the risk is because of the greenwashing out there. A lot of growth and technology being the main detractors in the market have featured a part of these portfolios. And of course, well, the press have weighed in, even Money Week, saying ESG investing could just end up being a classic mistake. But I was thinking, actually, we move forward in the next 10 years, I wouldn't be surprised to see policymakers, governments adopting much more sustainable policies and implementing them in our daily lives. And I thought, well, how could I bring this to life? So I've put here, many of you might already be familiar with this. This is the line coming from Saudi Arabia. Now, I've got a few notes here, and just to let you know, they're going to be two parallel lines, which are going to be 200 meters wide, 500 meters high, 106 miles long, and house 9 million people. You better get top to bottom from this city in just under 20 minutes, or 106 miles, and be no more than a 5-minute walk from any amenities you might need. Be completely renewable in terms of energy from solar panels, but also beneficial for the biodiversity and reusage of its own waste, which sounds fantastic. When I put on my ESG hat, I think, well, what about the carbon output that's going to be needed to create something like this? Because actually the reality is that's the pipe dream. The here and now is a bit less sexy. When we look at things like renewable power, heightened from the Russia-Ukraine crisis, and now even the rise of nuclear power looking to be more sustainable, and the rise of uranium. We then have robotics continuing to play a part in the automation industry, but also it's going to continue to drive labor efficiency, keep production high, but also bring down costs. You know, healthcare innovation, the idea of personalizing healthcare is particularly prevalent in the US. From early trials, we're seeing great use of sequencing of the blood to treat instead of traditional methods like chemotherapy to treat cancer. You know, businesses are adopting more sustainable profiles and decarbonizing through solar powers, etc. Maybe things you've been thinking about using in your own businesses. And to my last point on financial inclusion, we know actually coming from the emerging world, the rise of Web3, digital assets, cryptocurrencies will be a huge part of this. And if you compare it to the late tech boom where the internet had 150 million users, was growing at an adoption rate of 53%. And that's the quickest adoption to technology that we've ever seen in our lifetime. Compare it to the digital assets, cryptocurrency, Bitcoin, where we have 157 million users, so fairly comparable in user base, but it's growing at an adoption rate of 113%. So that's twice as fast as the quickest adoption to technology that we've seen in our lifetime. So those are my key themes and where to be aware of going forward. I think actually when we break it into my just last slide and my key takeaways, think back to the beginning of the presentation. Those key themes remain and continue to evolve, but also we've then taken it up a level. And we know that actually the outlook does remain challenging, but there are some great opportunities out there, from the sustainable inside of the bond market to those 3 key pillars: income, safety and volatile markets, diversification from equities, 5 to 6 years duration with the numbers to be aware of. But also remember, volatility is there to serve you. And also when we put that sustainability profile over the top and how vital as the world moves to this new economy, it's going to play a much bigger part in our lives. So all that's left to say for me is thank you for playing Speculate to Decumulate. It's been a pleasure playing all of it with you, and I hope you've enjoyed this session with me. So have a great rest of your day, and I wish you all a merry, happy Christmas and also a happy new year. Thank you.
Thank you, Elliot. Any questions for Elliot? Please remember to jot them down onto the questionnaire post-event, and he'll come back to you on those. And so we're on to our final speaker of the day, our resident guru, Lisa Webster. I'm sure many of you will be familiar with Lisa as either watching on one of the webinars or on our in-house events before. Lisa's back today and she's telling you why you can keep calm and claim tax relief. The recent economic and political turmoil has seen several different levels of income tax and national insurance touted. Some changes have stuck, whilst others are quickly resigned to the scrap heap. Throughout the upheaval, the basics of our pension tax relief works has remained unchanged. And today, Lisa will talk you through the different methods of claiming tax relief, as well as the case studies on the interaction with high income child benefit charge and the removal of the personal allowance. Lisa, it's over to you.
Hello, so welcome to our Christmas Connect technical session. So yeah, I'm going to talk about tax relief in this session, and the reason I sort of picked this subject is we've obviously had loads of changes this year, or lots of changes that have been suggested, not too many have stuck, in regards to income tax, and then there's been a knock-on effect, or there would have been a knock-on effect on pensions tax relief. So, I mean, we had sort of going all the way back to the spring statement, which seems like a long time ago. You know, we had an announcement that basic rate tax was going to go down to 19%. We then had the mini budget where additional rate tax was going to be scrapped. Obviously, we had U-turns on that. We had where basic rate tax was going to be lowered. That was going to come in earlier, and we were going to have a year where we had income tax at one rate and basic rate tax relief and pensions at a different rate, and you know, that would have been an interesting situation. And then, you know, we are where we are now, which is almost back to the beginning, where not an awful lot has changed. The only changes we have seen is the cuts that's going to be coming in next year to the starting point for additional rate tax, and then we've got the freezing of the allowances. But because we've had all these changes this year, there's been a lot of times where, you know, as techies, we've had to have a look at what the implications would be for pensions tax relief. And certainly, you know, particularly after the mini budget, we had, you know, journalists and things who were asking, you know, about all the planning opportunities around it. You know, what does it mean to use carry forward? You better get tax relief in this year when you're paying higher tax. You know, what would happen, yeah, when you have different rates of tax relief in the pension to the basic rate tax that we were going to pay, and lots of different calculations and lots of things, that different scenarios that we looked at. And as I say, we are almost like back to the beginning, but it just made me think about the basics of tax relief. And we have the basic premise that pension tax relief is granted more or less at the rate that you pay tax. That's what you get your tax relief on. You get tax relief at the rate that you pay it. And that hasn't changed. And throughout doing all these calculations, with that slight anomaly where we had, you know, maybe we're going to have a different rate for a year of tax relief, basic rate tax relief in a pension versus what we were paying, with that exception, you know, it doesn't really make that much difference. But there was a lot of questions about it, a lot of discussion about it. And it just made me think, you know, it's worth sort of going back to basics of how pension tax relief work and different methods of claiming tax relief. So that's what we're going to look at. Start off with, you know, the different methods of tax relief, practical examples of those, and then I'm going to look at these two pinch points that we have, which, you know, where people end up paying a lot more tax than any publicised or sort of by the government, you know, rate of tax, which is one around the high income child benefit charge. And then the other one is about the removal of the personal allowance. So I'll have some examples around there of, you know, how those tax charges work, those rates, you know, what can you do about it, sort of for clients who are in those tax bands. So starting off with the tax relief, with the basics then. So two main methods of claiming tax relief for member contributions, personal contributions into a pension scheme. So the one we sort of personal pensions, you know, are most familiar with is relief at source, or RAS. So all personal pensions will operate on a relief at source basis, including your SIP. Obviously, our SIPs all operate on this basis. So for a relief at source scheme, each pension scheme has to be registered with HMRC in order to be able to give relief at source. All personal contributions in relief at source pension schemes come in paid on net of basic rate tax, regardless of how much tax an individual pays, you know, including, you know, non-earners who can put in up to the basic amount. So, you know, for every £800 you put into a personal pension under a relief at source, you get the £200 tax relief on that to bring it up to the £1,000. So £1,000 gross contribution. Paid net of basic rate tax is £800, so you have that £1,000 ended up in the pension. Anybody who claims higher rate of tax, anybody who pays, sorry, higher rate of tax, would have to claim that extra back from HMRC. So that's obviously going to include high rate taxpayers and additional rate taxpayers, most obviously, but also if you have any clients who are Scottish tax residents, then it's the intermediate rate taxpayers in Scotland as well that pay a 21% tax rate, to get that extra 1% back, they would have to claim that back from HMRC. The other main method of getting tax relief on member contributions is under net pay schemes. Now, a net pay scheme can only be an occupational scheme. You can't have this through personal pensions. And the way it works is because it's an occupational scheme, it's linked to an employer, is a sponsoring employer of the scheme. And that sponsoring employer deducts all member contributions from their employees' pay before they calculate the income tax. So the whole gross amount gets paid across into the pension scheme. So if it's a net pay scheme, the actual pension scheme itself doesn't claim the tax relief because the tax is never paid in the first place. So it's not a case of paying it through PAYE and then claiming it back again from HMRC. Some of the pension scheme, maybe some outside. It's just because it's not paid, there's nothing to claim back. Income tax isn't calculated on it. So in a lot of ways, that can seem a lot more efficient, certainly for people who pay higher rates of tax. There are issues that we know about with net pay for low earners, because if you earn up to, in the personal allowance, you don't get any, because you don't pay any tax on that. Under a net pay scheme, you don't get any tax relief on it. Whereas under a relief at source scheme, if you put it in, you do still always get the 20%, as long as it's within either your UK relevant earnings. So you might be earning £10,000 a year, you could put contributions of up to £10,000 a year and get tax relief on it. So you pay an 8,000, get 2,000 tax relief, even though you've not actually paid any tax on it. That doesn't work with net pay. So there are differences there. To give a practical example of how it works and how it's calculated, I've got a comparison here between the relief at source method and the net pay. For somebody here who has annual earnings of £78,000 a year, and they want to make a £325 a month member contribution. So it works out then, £78,000 a year, that works out as their basic pay at the top here of £6,500 a month. So under relief at source, you'll see that is the amount that they get taxed on, that's their taxable pay. Under a net pay scheme, because the gross pension contribution, the £325 a month, that comes out before tax is calculated. So actually their taxable pay is low, as you get that 6,175. Whichever method you use, you have your personal allowance, so you don't pay any tax on that. They both then have the basic rate tax band, which for this year and going forward, because obviously we have frozen allowances, basic rate tax on a monthly basis works out. The allowance is £3,142, so you pay 20% tax on that. You then have your higher rate tax band, which on this case will be on the balance because they don't go up into the additional rate threshold. In this example, they don't earn enough. So you can see here, this is where the difference is, because there's less left to fall into that higher rate tax band. So under the net pay method, there is less income tax for them to pay. Next I've got on here is national insurance contributions, because it's important to note that net pay doesn't make any difference to your national insurance. So though your gross pension contribution is deducted before you calculate your income tax, so you only paying income tax on the 6,175, you still pay national insurance on the full amount of the 6,500. So, we do the calculations of that. The band for national insurance contributions has now been aligned with the tax band. So it's, it's a band of 3,142 that you're paying the main rate at 12% and then 2% above that. So your national insurance contributions is the same whether you do relief at source or net pay. You've then got your take-home pay here. So you can see this is what actually gets paid into your bank account at the end of the month. So the relief at source there, you have a take-home pay out of your 6,500 of 4,525 versus with your net pay 4,330. But of course, under relief at source, you haven't made a pension contribution in those calculations. So in order to get £325 into a pension under relief at source, you would have to make that net of basic rate tax. So that works out as the £260. Which comes out, you'd pay that out of your bank account, and then that goes into, that 260 goes into the relief at source scheme where the £65 claimed by the scheme administrator under the relief at source system to end up with the £325 in the pension scheme, the same as you would have under net pay. But also, because this is a higher rate taxpayer we're talking about here, they get the higher rate relief on it, which they would have to claim back from HMRC, which is the extra £65 down here. They get that on top of the £65 that they've got in the pension scheme, which you can see by the time you've done that, you end up with a 4,330, exactly the same as you have under net pay. So you end up in the same position. And you could say for somebody who is a higher rate taxpayer, like in this example, that net pay is easier because you don't have to do this bit here. And you don't have to, contact HMRC to get your extra tax relief on it. So the losers on it are the people who don't pay tax. Their contribution anyway under they don't get the tax relief, under net pay like they would do under relief at source. So in practical terms, then how do you go about claiming your extra tax relief? So most people will claim it will be via their self-assessment, and this is just the section from the self-assessment form that you have to complete under tax relief, where it says payments to registered pension schemes where basic rate relief will be claimed by your pension provider, so your relief at source. So in that section there, you always enter the gross amount. If you've got somebody who's using their full annual allowance and they're putting it in as a member contribution, so they're physically paying in £32,000 in order to get £40,000 in the pension scheme, it is £40,000 that you would enter in that box on the self-assessment form. It's important to note if somebody goes over their annual allowance, that is a separate issue, if you like, and I'm not really going to talk an awful lot about annual allowance today, but it's just worth noting that it doesn't affect what you put on this section of the form of the self-assessment. As you can see in the small print, the notes at the top, it does say if you go over your annual allowance, you have to note that somewhere else, and they kind of cancel each other out to a certain extent. But you do need to claim the full tax relief first on this. For people that are not additional rate taxpayers, who don't have any other reason to complete a self-assessment, they can just contact HMRC directly to tell them about their pension contributions to claim the extra relief without necessarily have to complete a self-assessment. So if they are additional rate taxpayers, then they do have to do a self-assessment anyway. But it depends what other income and investments, whatever else they've got to declare. But if it's literally just the pension contribution, they could just contact HMRC direct. And they say that might be appropriate, particularly say for those intermediate rate taxpayers in Scotland, aren't particularly high earners or anything like that. To get that extra 1%, which we don't have stats for because HMRC don't release them, but we kind of think there's probably quite a lot of people who fall into that tax bracket in Scotland who don't claim the extra 1%, but for them to do that as well. So that's kind of like the practicalities of what they need to do to claim the tax relief. But then I'm going to have a look at how that works in practice. So when HMRC have that information, how do they apply it to calculate the tax due for an individual? So this is an example where we've got somebody whose gross income is £80,000 and they're going to make a £32,000 net, £40,000 gross personal contribution. Looking at what would happen, say if they've done this under a relief at source scheme, then they sent the information off to HMRC. What does it look like, the tax calculations for them? So we'll start off by just having a quick look at what happens if you don't make a contribution. So we start off here. So we have a personal allowance of 12,570, which you don't pay any tax on. You then have the next 37,700 you pay your 20% tax on, your basic rate tax. And then without any pension contribution, the rest of the 80,000 income, the balance of that, which is 29,730, falls into the 40% tax band. So income tax for the year is calculated as 19,432. If they make the £40,000 gross contribution, then what happens is you start off with the same position on your personal allowance and your basic rate band. But what happens is the pension contribution effectively expands your basic rate band. It's an extension of that 20% rate. So if you make a £40,000 gross contribution, you can have up to £40,000 of income that will fall into the 20%, the basic rate tax band. So in which case, all of it moves that wasn't the 40% tax band now falls within this extended basic rate band. So instead of paying 40% tax on the 29,730, they only pay 5,946. So we work out the tax, the total tax for the year. And you can see there the difference between those two, the 19,432 and the 13,486. That's the higher rate relief that we can claim from HMRC. So depending on the amounts involved, they'll either do that as they could do as a tax rebate, or they could change the tax code for the following year in order to pay the money back that's effectively been overpaid on that. The other way you could calculate that is, you know, you've got £80,000 of gross income less your basic rate so your basic rate band, your basic rate threshold, the higher rate threshold, times 20%. So it's effectively anything that's above the higher rate threshold, you get the extra tax relief on that you came back from HMRC, in which case this is 5,946. But also don't forget you have had £8,000 tax relief in the pension scheme as well. So your total tax relief is going to be the 13,946 on that. Sometimes when we talk about relief at source, you hear people sort of talk about getting tax relief at your marginal rate, which is sometimes true, but technically, if you're going to be really picky about it, you could say, well, in this example, this individual's marginal rate of tax is 40%, and they make a contribution. They don't get 40% tax relief on the full amount of the contribution because it's not all over the higher rate threshold. Because obviously, if they're 80,000 of income, take away the 40,000 contribution, that brings them down to £40,000 income, which, you know, obviously is still in the basic rate band. So you only get it on the portion that's above the threshold. So they get a bit of a basic rate relief and they get a bit of it at higher rate relief. So it's not all at their marginal rate of higher rate tax, the relief that they get. So it's just want to be careful of when, you know, with the wording, sometimes it comes across slightly differently. Next example then, just for somebody who's an additional rate taxpayer, and I have used the figures here which will apply from next year. So when the threshold is at the slightly lower amount, the 125,140, it kicks in at. So we have somebody here who's got £170,000 gross income, additional rate taxpayer. If we just calculate the tax without making any pension contribution, at that rate, they don't have a tax. They don't have any personal allowance because it's all been removed because they are over the threshold for the removal of personal allowance, which we'll look at in a bit more detail a little bit later on. They then have the same basic rate band, 37,700. They then have the higher rate band, which is 87,440, and which we say will be next year. And going forward, and then they have the 45% on anything above the 125,140. So total tax works out 62,703. If they make that £40,000 pension contribution, they still have lost their personal allowance, because even with the pension contribution, that would bring them down to £130,000 of income, which is still over the threshold. So they still don't have a personal allowance. They do have the basic rate band. But here we have, like I said before, the way that HMRC will apply it in the calculations is they will extend your basic rate band by the amount of the contribution. So because they have an extension of the full £40,000, so the £40,000 there, they now pay basic rate tax on. They still have the same amount falling into the higher rate tax band, and they've just got a little bit left over in the 45% band. So effectively, you've moved £40,000 from paying additional rate tax up into the 20% band instead. So it saved them, as you can see, there's £10,000 difference there. So that is the additional rate tax relief that can be claimed from HMRC. Again, on top of the tax relief that you've received within the pension scheme on that, which adds up together to make the additional rate relief. Last little bit on looking at different methods of tax relief then. So salary sacrifice is different because salary sacrifice technically means you're making an employer contribution, not a personal contribution. So from a tax relief point of view, an employer making an employer contribution, providing it meets the wholly and exclusively rules, it is them that will claim the tax relief against corporation tax for the business. Looking at this from the individual's point of view, though, if they started off with reference earnings of £60,000 a year, but they sacrificed £1,000 a month of that for an employer contribution instead, we look at the position. So if you're on £60,000 a year, before you do the salary sacrifice, you would be on £5,000 a month pay. Afterwards, because you've got this £1,000 a month salary sacrifice, you're only on £4,000 a year. Sorry, £4,000 a month, sorry. You then do the tax calculations as normal. Obviously, you've basically taken your earnings out of higher rate tax by doing that. But it's when you do the national insurance contributions that makes the difference. So for an employee's point of view, they have a national insurance savings. So this is the difference, big difference between net pay and salary sacrifice. Sometimes people get a bit confused because both of them are the employer deducting it effectively out of pay, reducing pay. But the difference is because you've actually given up your earnings in salary sacrifice, you don't have that income anymore as such. You don't have to pay national insurance on it. So it lowers the amount for the national insurance calculations. So your take-home pay, we work out here, obviously, you're going to pay more tax and more NI before you sacrifice the salary. So you have this take-home pay here of 3,655, but obviously you need to get £1,000 into your pension still to put it in the same position to be a fair comparison, which would be an £800 net contribution. £200 would go under relief at source into the pension scheme, and then you have your higher rate relief as well, which comes back in, and so you end up with 3,017. So the difference between these two figures here works out as £39, and that is the monthly NI saving on that £1,000 of salary sacrifice. So tax position, income tax position is the same either way, but it's the NI savings which help with salary sacrifice. Of course, there is also corresponding employers' national insurance savings as well, which can be even more significant. Now, depends on the employer. Sometimes the employer might pass all of that saving on to their employee. Some of them, they may split it. Sometimes they won't. It'll just be the employee that saves, and then obviously it's a saving for the employer as well. So it is slightly different to say because it's not classed as a personal contribution. It is an employer contribution, but it is a very tax efficient way of doing things. The only things you have to be a little bit careful with on salary sacrifice are because obviously it does reduce your income. So for people who are applying for a mortgage, people who are getting life insurance, and it's multipliers of salary. Obviously, their multiplier of salary is going to be lower if they use salary sacrifice, which you wouldn't do under the other methods. And then the other thing, just to be a little bit careful of, is it can have an impact on means tested benefits, things like maternity pay, things like that. If you have a lower pay to start with on that. Okay. Moving on now to look at the high income child benefit charge, which I think has always been fairly controversial since it was introduced, and I think it's probably becoming increasingly so, especially it's like the title of it, that isn't the name of it high income? Do you really define what you call high income? So the child benefit charge, the high income child benefit charge, applies if either the individual or their partner are receiving child benefit and either of them have income above £50,000. So yeah, the question is, are you really, on a high income if you earn £50,000, especially when you consider the fact that if you earn £50,000, you're still a basic rate taxpayer. And obviously with the allowances being frozen, for the next few years, as more and more people are going to be dragged into higher rate tax, more people are going to move up the ladder. And £50,000 probably isn't really particularly high income. It's also seen as quite unfair, I think, because you could have two you can have a couple where they both earn £49,000 and they don't have to pay it. But if you have, you know, somebody else where they have a non-earning, one of them's staying home looking after the kids and the other one earns, you know, £55,000, then you do have to pay it, which doesn't quite seem fair. There's also a few funny things in it that it doesn't actually have to be your own child in relation to. So you might have a client who then moves in with his partner who has a child from a previous, or the other way around, the partner has a child from a previous relationship, so it's no blood relative of theirs whatsoever. But if their partner is claiming child benefits and they live in the same house and they earn above £50,000, and they could end up paying the tax charge for it. And also that £50,000 income, it's not just earned income, it does include interest from savings and dividends as well. So there's a lot of people that are going to be hit with the high income child benefit charge. The way it works in terms of, you know, how the charge is calculated is for every £100 earned in excess of £50,000 threshold, then the tax charge increases by 1%. So this means that if you earn £60,000, the tax charge is 100% of your child benefit. So therefore, it wipes it out basically. You know, if you earn £55,000, then you pay back your child benefit charge is 50% of the child benefit that you receive on that. You can opt out of having the child benefit in the first place, but you do have to be careful on that one, particularly if you have got a situation that somebody is not working, if somebody's, usually the mother, but not necessarily, who isn't working because they are staying home and looking after the child. And then you've got, you know, if you have the father who's then basically who earns more than £60,000, so you wouldn't actually get any money from the child benefit anyway. You might just think, oh, you may as well lose out. But then the problem is that the person who's staying home and looking after the child will lose their NI credits that they would otherwise get for being the primary carer. So for that reason, it's important to still register for child benefit. The other thing is that if they're on the system, the child automatically gets an NI number when they turn 16. You don't have to apply for it separately. Otherwise, they're not in the system for that to happen. So even if you have clients that become new parents, and yeah, one of them earns more than £60,000, they wouldn't get any income from it, it's probably still worth them completing the claim form. But there is an option when you claim child benefit now that you can tick a box for it not to actually be paid. In which case then you don't have the high income child benefit charge. So there's just a few sort of practicalities around that. So let's have a look at an example of the numbers, how it works, you know, what people can end up paying or not. So somebody has £60,000 income or higher, then they end up with basically the full amount of the charge. But if somebody on £60,000 income, if they have 2 children, then the child benefit for the year works out as £1,885 this year. It is one of the benefits that is linked to CPI, so it has been confirmed it is going up, linked with September CPI for next year, so we know it will be £2,075 next year. So if you work out the income tax on £60,000, that works out as £11,432. Your high income child benefit charge would be the full amount if you earn £60,000, because the tax charge would then become 100%. And so your total tax for the year, if it was this year, so income tax plus the high income child benefit charge will be £13,317. And next year it would be £13,507, because you'd be paying back the full amount that you'd got on that. But obviously what you could do is make a £10,000 pension contribution. So if you had a £10,000 personal contribution to a pension, that would then reduce your income tax, and it would completely eliminate the high income child benefit charge, because your income would come back down to the £50,000. So that would mean to put £10,000 contribution into a pension would save £5,831 tax in the current tax year. Next year it would save you £6,021. Or another way of looking at it, if you like, is this year it costs you £4,169 to get £10,000 into a pension, and then next year it'll be the 3,979. And this gap is if the effect of what it's going to cost you is going to get less and less over the next few years, because if we know the thresholds are frozen, and if the thresholds don't change for the high income child benefit charge, if those thresholds are frozen, but benefits aren't frozen, they do go up with inflation. So the tax charge, more and more people are going to be dragged into it. The child benefit is going to get higher and higher, therefore the tax charge is going to get higher and higher, therefore the savings are going to get bigger and bigger. So this is one that's going to be moving in terms of what the actual rate of tax is, the real rate of tax is for people in that position. So obviously anybody around those bands is definitely worth considering on that. Okay, removal of personal allowance, then the last bit to talk about today. So this starts at £100,000. So every pound of personal allowance, sorry, a pound of personal allowance is removed for every £2 that somebody earns above £100,000. And once the income reaches £125,140, all of the personal allowance is removed. So if you earn above that, you don't have a personal allowance anymore. So this tax year, we have a funny bit in it in terms of our tax rates, because you end up losing your personal allowance between 100,000 and 125,140. Then you have a tax rate of 40% between 125,140 and 150,000, and then after that you're taxed at 45%. But from April next year, then the additional rate tax threshold is coming down to £125,140. So as soon as you finish losing your personal allowance, you'll go straight into the additional rate tax band. So this is what it'll look like next year. So your income between the 0 and up to 12,570, you get to take it all home. You then have the band, the basic rate band, where you pay 20% between 12,570 and 50,270. Then up to 100,000, where you pay 40% tax. Then this band here, between 100,000 and 125,140. This is where you have an effective rate of tax of 60%, because you're losing your personal allowance as well as paying 40% tax. And then it'll drop down to 45%. At the moment, we have a little bit in between here where we go to 40% and then we go up to 45%, but this is what it'll look like for next year. So another example for this one, how this works in practice and how beneficial it can be to make pension contributions. So somebody who has £125,000 of income, if they don't make a pension contribution, they've lost nearly all of their personal allowance. They've still got £70 left, which they don't pay tax on. They then have their basic rate band, and everything else falls into the 40% tax band. So their tax bill for the year is £42,432. If they make a personal contribution though, so let's in this example make £20,000 net, £25,000 gross personal contribution. In doing that, they can get back all of their personal allowance, because it brings their income right down effectively to £100,000. So you can get all of your personal allowance back to pay no tax on. You then have your 20% band as normal. You also have the extension for the £25,000 contribution you've made, and then you have high rate tax on the balance on that. So it works out as £32,432. So you've got a £10,000 difference there. So that £10,000 difference, that's the bit that you claim back from HMRC, but also you've had £5,000 tax relief within the pension, because you've put in a £20,000 net personal contribution, got 25,000 into the pension. So you've had 5,000 in the pension, 10,000 outside it. So effectively, you've had 60% tax relief on it. So yes, you pay 60% tax in that tax bracket, but if you put it into a pension, you can get 60% tax relief on it as well. So people who are sort of around those margins, these kind of numbers in terms of their income, it becomes even more valuable, more worthwhile to put money into a pension to get back not just the tax they've paid, but also to get back their personal allowance as well. So to summarise then, so with all the rates and the allowances being frozen from next tax year, pretty much all of us are going to be paying more tax, but using pension contributions can help mitigate some of those increases, and particularly around those pinch points. So the £50,000 to £60,000 bracket for people that have children or pay they or their partner claim child benefit, because obviously with the savings around the high income child benefit charge. And then again, the next bracket, those between 100 and 125, 140, with the loss of the personal allowance, then the savings that can be made there are particularly significant as well. And these, because we're frozen until at least 2028, there's going to be more and more people who are coming up paying more tax, going into higher tax brackets, that this is going to have an impact on. So that is all from me for today. So thank you very much. I hope that's been of interest, and I hope you all have a great Christmas.
Thank you, Lisa. So that concludes our AJ Bell Connect session. Thank you again for joining us. And as mentioned earlier, an online feedback form will appear on the screen immediately after this webinar closes, and we'll really appreciate you completing this to tell us what you thought of today's content. CPD certificates and a copy of the slides and a link to today's recording will also be emailed to you in the coming days. Our AJ Bell Connect sessions will take place in the summer of 2023 and are now open for registration. We'll put a link in the details onto your post-event email, and hopefully you can join us at the session near you for some next year. Again, thanks for joining us. Enjoy the rest of your day, and from all of us at AJ Bell Invest Centre, have a Merry Christmas.